Give you a quick down and dirty recap of the client I got pre-approved today. Here's the long and short of it. He tried to get pre-approved at a local bank about 2.5 years ago. That lender told him that he wrote off too much on his taxes. He didn't qualify, so he needed to adjust his write-offs, actually reduce his write-offs in order to show more income on paper, and he then would be able to qualify. Well, interest rates have only gone up. He went to that lender last week and said, I'm ready to get pre-approved. He went through the process, still denied, didn't show enough income, and has been writing off less the last 2 years to show more income on paper. Being self-employed, being a business owner, one of the biggest assets and tools you have is write-offs to reduce your tax liability. But he was following this loan officer's advice. I actually know this loan officer personally, so I'm surprised they gave this advice, but that's not the point. The point is, this client, when we did the numbers, basically ended up paying the IRS $46,000 more than he had the previous years he had his business, because he reduced his write-offs to show more income on paper so he could qualify for a home loan based on this loan officer's advice. He then came to me, we talked. After getting denied last week, he saw me on social media, came to me, we looked over his numbers, we got him pre-approved on a bank statement loan. He's out actually shopping today because he doesn't have to provide tax returns on a bank statement loan. So the big thing here is the interest rates on a bank statement loan are higher than they are in conventional. No one's denying that. If anybody does deny that to you, they're lying to you. They just simply are lying. Bank statement interest rates are higher, but here's a good example. If you have a conventional loan, and this is all hypothetical, not a commitment to lend, here's all my disclaimers. I'm not saying this is a real rate. I'm just using it as examples because I know the numbers off the top of my head. If you have a $500,000 loan, conventional loan at 6.5%, your monthly principal and interest payment is going to be $3,160, okay? Now, if you take a bank statement loan, your interest rate, in most cases, not all the time, again, disclaimer, this isn't a commitment, it's just an example. Let's say it's a 0.5 point higher, which is what I typically see based on profile. $500,000 loan at 7% versus 6.5%, like we just talked about on conventional, is $3,326. So you have a $166 a month difference higher on a bank statement loan. Well, $166 a month times 12 comes out to $1,900 something. Let's call it $2,000. So you're going to pay $2,000 more a year in interest on a bank statement loan than you will on a conventional loan in most cases. So let's say over the last 2 years, this client reduced their write-offs, which they did, and they paid the IRS more than they ever have in their life, which they did. This client's used to paying about $10,000 to the IRS a year. I can see it from his tax returns. I know where it's at. I've just seen it, and he told me that. So he was used to paying $10,000. Over the last 2 years, each year, because he reduced his write-off so much, he paid $46,000 a year more to the IRS by reducing his write-offs and not utilizing that tool and asset as a business owner. So over the last 2 years, he paid $92,000 to the IRS. He could have got a bank statement loan 2 years ago from me and not even given me tax returns, still bought a house, done all of his write-offs. So essentially, $2,000 more a year in the payment scenario I gave you in interest on your mortgage is $4,000 over the last 24 months. This guy paid $92,000 to the IRS because this loan officer that he talked to originally 2.5 years ago told him he needed to write off less. This is the amount of money he needed to show on paper, and he'd be able to buy a house. They still denied him last week. He's paid $92,000 to the IRS. He would have just paid $4,000 or so more in mortgage interest. So $68,000 over the last 2 years is what he would have saved. Like, that's like $3,000 a month. I mean, pretty close to it, right? $2,750 a month he would have saved. That's a mortgage payment. Like, he would have saved his entire year's worth of mortgage payment almost if he would have just got a second opinion. So he did get a second opinion. He's working with me, but bad financial advice from loan officers who, this loan officer also talked to the CPA. This guy told me his CPA and the loan officer sat down, and the loan officer said, this is the amount of money that he needs to make on paper to qualify for what he's trying to do. So he literally sat down with a tax professional and told them the amount of income that they needed. And then that tax professional followed his advice and they still denied him. So I got to be the person to tell him he overpaid on his taxes. He didn't need to do that. He's qualified, and he would have bought a home 2.5 years ago if he would have just got a second opinion and looked at what programs were out there for self-employed business owners.